Good morning. Welcome to the B.F. Anderson Technical Report for July 29th. This is going to be a busy week this week. We've got the Federal Reserve FOMC meeting concluding on Wednesday. We'll get their results as to whether or not they're going to cut rates, leave rates the same, or raise rates. We really don't know. All indications are, though, the Fed will cut rates at least 0.25. This is an attempt by the Fed to stimulate the economy. So the stock market is certainly telling us that things are going well with the economy. We have low unemployment and we have low inflation. This is really unusual times that we're in. I would say the last time we were in a situation like this would have been back in the 1950s. So, the window of opportunity is probably opened here. It's going to close at some point, so you got to make hay while the sun shines. But anyway, as we look at the charts, you can see here the Nasdaq, we went through somewhat of a pullback in May. Then we rallied back above the moving averages, making new highs now. And the 25-day moving average has now moved above the 30-day and looks very, very positive. On a weekly basis, last week volume was below average. However, we did have an up week with up volume. And again, you can see that we are hitting new highs on the Nasdaq along with the 35-week moving average turning up. Now, we'll talk a little bit more about the 35-week in just a minute. The advanced decline line is continuing to look constructive. We started to flatten out, turn down. However, we're picking back up into an uptrend, and things are looking good on advanced declines. Now, on the high-low index, now remember what we're looking at here is how many stocks on the New York Stock Exchange are making new highs versus those stocks making new lows. And as you can see, we pulled back in that number and we rallied, somewhat consolidating. Looks good, though. The number of new lows on the New York Stock Exchange have kind of gotten a little elevated here. We were at 75 on Friday, and you can see we've been above 40 here for a couple of weeks. And so just be aware of that. It's not the best sign, but we want to try to see that number stay below 40. Now, on the long-term indicator, again, this will be updated at the end of this month, which will be Wednesday. Index is breaking out to new highs, so this particular line, which is the 10-month moving average, will definitely turn up and look very constructive. We really want to avoid the market when it's in periods like this. This is a very difficult period. The fear-greed index. Now remember, fear is a very powerful emotion, but so is greed. In fact, I've seen greed back in the 90s, it really got almost completely out of control. Alan Greenspan called it irrational exuberance. Well, we've moved back into neutral, so that's looking somewhat more positive. We don't want to see extreme greed. It can be an indication of an overbought market, but it does appear that the fear-greed index is starting to stabilize around neutral. Now, this graph here, we've got the S&P 500 compared to a 200-week moving average. Very constructive pattern. I mean, you just couldn't have a prettier chart than this. This is just an absolute perfect uptrend, making new highs, continuing to make higher lows. This looks very, very positive. The value line geometric, now this is the only thorn in the side of the market. We're not getting a breakout in the average stock. In other words, the reason this index is important, and as we know, this is not market cap weighted, this is an equally weighted index of 1,700 stocks. When this index, like back here in the 90s, when this index really gets going, it's telling you that the market is broadening out. You're not seeing just a few stocks lead the market. The overall market is doing well. Well, we're in a constructive pattern. We're just not making new highs. Same thing for the global Dow. This is the biggest concern for the Federal Reserve. They've almost become more of a Federal Reserve for the world versus just the United States. And they are concerned. Richard Claudia made it very clear that they are concerned about the sluggishness of the European economy, and you can see it where we're not making new highs on the global Dow. Now, my good friend Mike Santolo, he's with Cabot Research up in Salem, Massachusetts, has developed an indicator called the 7.5% rule. Now, what the rule indicates is when you've had a correction in the market, so if we go back to last year, we actually had a bear market last year. I mean, the market rolled over September, October. December was the worst December on record. This ended up being a drop of about 19.8%. So that is close enough for me to define this as a bear market. So once you get a bear market, then you get a recovery. Now, as we know, the market's not going to go up in a straight line. It's going to have pullbacks and it's going to have corrections. So what the purpose of the 7.5% rule is to go back and study these types of pullbacks. Then if you get a certain type of quick, like a V-bottom quick response, what can that mean? Not what does it mean, what can it mean? So anyway, what the rule is that the S&P 500 index closes the week 7.5% higher than the 35-week moving average, and it must be the first signal for 9 months. In other words, it has to be following a drop. In other words, and the other condition is that the market drops below the 35 moving average. So what's happened is we drop below the 35-week moving average. It's been 9 months. Then on this period, this week here, which is July the 5th, we got a 7.5% spread between the index and the moving average. Now, this has only happened 11 times since 1980. Now, I have an error here. This is not correct. The average gain 12 months later for the S&P 500 is 21%, and the average gain for the Nasdaq is 33.6%. And I think even more important, the pullbacks during the next 12 months should be minor. I mean, we're talking 2 to 3% pullbacks, and that's a very constructive pattern. Now, also what I did is I went and looked at the S&P 500 during periods where it looks like the market is bottoming and resuming an uptrend, which is what I think we're dealing with right now. So if you look at our current situation, now what we're looking at here is a weekly graph where I'm looking at the 30-week, the 40-week, and the 50-week moving average. I've removed the index, and all you have here are the moving averages. Now you can see here, nice uptrend. Then we go into a consolidation starting late last year. Chop, 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 not real definite, market moving sideways. Then all of a sudden, boom, we get this kind of breakout here. And so this current market is looking more like a bottom than a topping pattern. Now, if we go back to prior bottoms, which would be 95, 2003, and 2009, let's take a quick look at that. Now, here we have 2003, 2002, 2003. You can see where this is your bear market. This was the recession of 2000. We came down. Finally, we started to firm up, and it looked like we're forming a bottom. So if you go back to where we are now, this looks more like that than some other examples that I'm going to show you here. Now, here's another example. This would be the year of 2009, the great drop. You can see here, again, the downtrend and then the turn starting to make it. Now, this is the year 1995, 94, 95. So this was really an important period here. This is where we started the major bull market between 95 and 2000. So you can see again a lot of consolidation, and then boom, we turn back up. So just to go back to where we are now, you can see what I'm talking about. This is, we've had the consolidation, and now we're turning up. We're getting the 7.5% rule buy signal, and it looks like the Fed may be cutting interest rates, which according to another study, the market should do quite well over the next 12 months. So let's look at the top 5. Again, technology is dominating, advanced micro devices, semiconductors. You can see here that the stock continues to maintain a porosity around the 10-day moving average after giving a big gap up buy signal back here at the beginning of June. Here is in-phase energy. Again, this is solar. We're seeing the reports that I'm reading is telling me that the utility grade solar is what's really driving the industry right now. This is not about rooftop solar. This is what you call large scale solar plants that are being built by things like electric utilities. But you can see here in phase again, porosity around the 10-day. This is a company called Guardant Health. We own this stock, I have to say that. This company is involved in cancer treatments. What I'm hearing is that cancer cures are not really going to happen right now, or at least it's rare. But we're looking for is a way to treat the cancers just like an AIDS patient would be treated for AIDS. This is Guardant Health. This has to do with blood testing for determining cancers. Again, here's Roku, another stock we own. We're hanging in there around the 10-day moving average. Stock looks good. Here's a new stock. We just took a position in this company, Snap, which is kind of like a Facebook, very similar type of concept, but mainly for the younger crowd. So all in all, things are looking positive. This is a bull market. The window of opportunity has opened. So don't mess around. This is the time to get active. Thank you very much.